Hello, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, November 27, 2015. This was a short trading week, and there was really not much action that took place as far as any kind of meaningful breakout or breakdown in stocks. We'll look at New York Stock Exchange Composite Index, and it is nowhere near an all-time highs as opposed to S&P 500. We'll also look at bonds. The AGG, the aggregate bond fund, rebounded nicely, while the municipal bond fund made an all-time highs. So that's, I think, showing quite a bit of fear that's present in the markets. Dollar is also approaching 52-week highs, and of course, this is this is weighing on the various commodities: gold miners, copper, oil, and possibly natural gas that are weak, staying weak, and oversold and staying oversold. All right, so let's look at stocks. So this is SPY, S&P 500 ETF, kind of like a proxy for the markets in general. So this week, really there was not much clarity either up or down that took place. The S&P 500 kind of traded sideways, and there was really no resolution whether bullish or bearish. My personal bias is still bearish for various reasons. I outlined it in my previous videos. But just looking at this chart, if we do nothing else, we look at the 50-day moving average, which is red, and the 200-day moving average, which is in green dotted line. You can see the 50-day moving average is below the 200-day moving average. That's already putting a bearish bias into my analysis. Looking at the volume patterns on balance volume indicator, you can see it's trending downwards. Even though we made almost came close to making all-time highs and gaining on these all-time highs, you can see the volume patterns are clearly trending downwards. Let me see, where is this? The advanced decline lines, advanced decline volume lines, especially the advanced decline volume line has not broken out to the upside. The advanced decline line did here in November, beginning of November, but once again, I think still this is a bearish chart, and I think we will get at the very least a retest of these mid-November lows. If these don't hold, I'm almost certain we'll get a retest of these two lows, and in the near future. All right, next let's look at NYSE Composite Index. So this one you can see is significantly weaker than the S&P 500. As the previous chart that I just showed, the S&P 500 was really close to its all-time highs. The NYSE Composite is really nowhere near its all-time highs. In fact, this rally from August and October lows was rejected here at the 200-day exponential moving average, but more importantly at this broken support, which I marked here with a red line, which now turns resistance. So this is a pretty classic case of support break turning into resistance. And for now, looks like we're making a lower high relative to this one, and actually relative to all of these lower highs as well. So again, as with S&P 500, I think this is a bearish chart. I think we will probably get at least a retest of this November low, and again, as if we break support here, we may see a retest of August and September lows here. Let me point this indicator out here. So this indicator is a New York Stock Exchange Composite new highs less new lows divided by total active symbols. So this is a percentage of new stocks, new highs less new lows. So one of the ways to see if this is generally speaking, a bullish or a bearish index, we can see that if we're going to say that if this ratio falls below -5%, we're going to keep a bearish bias, and we're going to keep this bearish bias until we get to the +5% mark. Now, if you notice here, this indicator actually dropped below -5% back in July, even before this large breakdown. And ever since then, we have not seen a rebound above 5% yet. So you can see here it was above 5% here back in March of this year. But so far, we have not actually seen a rebound above +5%. So there is still not a lot of new highs that are being set within the index. And new lows are still well, new highs are now outnumbering new lows, but in any case, according to this indicator, particular one, we have not yet turned bullish on New York NYSE Composite. Also, I pointed this out several weeks ago, several months ago too. There's a continuing trend in advanced decline lines and advanced decline volume lines downwards, and this is kind of like a bearish sign, and until we get a breakout in the advanced decline lines, and especially in advanced decline volume lines, I will keep a bearish bias on this chart as well. Another bearish indicator on this chart is percentage of stocks above 200-day exponential moving average. Notice that it dropped below the 40% mark here in August and has not yet recovered even the 60% mark. I think we're still struggling with even the 50% mark. So what this means is that more than 50% of stocks are within the NYSE are trading below its 50-day exponential moving average, below this red line. So that's that's quite a significant selling pressure, and in other words, bearish trends that are still prevailing within the NYSE. The same thing here with a bullish percent index. You can see it dropped below 40% here, and it's yet to recover the 60% mark. So overall, I'm still bearish on stocks. We may see some back and forth filling here, but I would not be surprised if we break this November low and head down for at the very least a retest of August lows. In my previous videos, I actually laid out a case that we may be in a bear market already. And if we fail here, or even if we make slightly higher highs, we may actually roll over and continue making lower highs. And I think the analogy that people have been pointing out, that current picture is more like 2011, I don't think so. I think this current picture is more like 2008. And you guys know what happened in 2008. We entered a bear market. Okay, let's next look at bonds. So this is a iShares Barclay Aggregate Bond Fund, and this fund is kind of like a proxy for United States bond market, because it contains quite a bit of various bonds of all sorts, including treasuries. Now, here back on November 10th, I actually pointed this out. I said bonds are supported and set for a rally, and I went ahead and actually tweeted this as well. So let me show you that tweet. This was from November 10, 2015, and I tweeted exactly that. So since then, looks like we had a pretty nice gain. At the very least, we held support. So this drop here was following all this talk about Federal Reserve raising interest rates in December, and people are saying that, of course, rising interest rates are bad for bonds, and this is a normal kind of behavior, I guess. But to me, at this point of the game, I still thought that bonds were bullish, and even if you just go, this 50-day moving average is above the 200-day moving average, so this is already bullish chart. And this was an oversold condition, and I said that this is a good entry opportunity. So it looks like we so far at the very least holding support, closed this gap, and now we're trading above the 200-day moving average. Next chart I wanted to show is MUB, municipal bonds. So this bond fund holds all kinds of municipal bonds. Same thing on November 10th. There was a drop in muni bonds. What happened afterwards? We made an all-time high. Even this week we made an all-time high. So far, bond markets are not necessarily saying that rising interest rates are bad for them, but I think what bonds are saying and the investors in bonds are saying is that they are foreseeing some sort of a more selling pressure in stocks, most likely, because this is bonds usually correlate negatively with stocks. So whenever stocks go down, bonds go up. Maybe the bond investors are already thinking ahead and positioning themselves into a possible, drop for stocks. All right. Okay, that's all I wanted to say about bonds. Next, let's look at the US dollar index, USD, dollar sign USD. So several weeks ago in November, I pointed out this large white candlestick that to me looked like a breakout above these levels from July and August highs. So this looks like a breakout. We had actually a couple of throwbacks here and here, but both time price held its support and buyers stepped in and pushed the prices higher. Looks like we're getting very close to 52-week highs, and I actually believe this is going, if we make an 52-week high, this is going to be a multi-year high, if I'm not mistaken, a 14-year high. So the euro is under pressure. The reason being is Mario Draghi, the ECB chair president, is still implementing very accommodative monetary policies, and actually he's talking about more quantitative easing in the eurozone area. So this, of course, is weighing on the euro, and euro is about, I believe, 57% of the US dollar index is euro. So the dollar is clearly bullish and gaining into 52-week highs. If dollar breaks out to 52-week highs, and actually even right now, you can see next we will go into kind of like a commodities part of the presentation, and we will see that most commodities are really feeling the effect of the strong dollar. Of course, probably the biggest recipient of the pressure from the strong dollar has been gold and other precious metals, of course. So gold just hit another multi-year low here just on Friday, actually. Even though this was a short week for gold, it was a pretty eventful week. So last week I pointed out this support break with a close below July levels. So here on the 17th, I believe, we had a close below support here. We had a rebound, and this was actually another opportunity to get short. Basically, if you like this kind of play, I'm not a big fan of this, playing the breakdown or breakout. I kind of like want to wait for the bigger rebounds to materialize. But if you were playing it on the hourly charts, this could have been a nice entry opportunity here. Since then, obviously, we broke down again with a close even below these lows here. So we're now at 1056. So, very bearish chart, multi-year lows. This breakout clearly failed. Back in October even, and if you remember, then you have been notified about this opportunity, and you're probably already sitting on very nice gains if you took this shorting opportunity. Now, where is this going? So how far down? What's the downside target for gold? So one way is to estimate. So you can kind of see that this maybe is kind of like a cup and handle pattern. This is a goofy looking cup with handles, or maybe this is an inverse, I don't know, double-headed something or other. But in any case, the point of the matter is that usually the way to estimate the target is to just see how high this pattern is, or how high this pattern is, and usually that just gets duplicated on the downside. So let's just do this right now real quick. And we'll be conservative. We'll measure it from here versus from here. So conservatively speaking, we're looking at about another $77, or about 7% to be duplicated on the downside after the breakdown. So about $70 more would put gold at around $1,000. Of course, if we measure from here, this would be even higher, so that's another $107. So we may actually see gold below $1,000. As far as when this is going to happen, I have no idea, but you know, certainly this is a bearish security, and there is more selling than buying. Well, let me rephrase it. There is more selling pressure. Selling pressure is winning at this point right now. All right, next is GDX Market Vectors Gold Miners ETF. So unsurprisingly, you can see the patterns are kind of similar to what we see in gold, but it's more volatile. And I mentioned that GDX is one of the most volatile securities out there, and it's quite difficult to trade. But once again, you could base your decisions on gold because it's a little bit less volatile, and then potentially just make purchases in GDX or inverse of it. Anyway, so similar pattern here. We had a breakdown. Now gold did break down below the support from July, but GDX has not broken down so far, I think. So ideally, I want to see a conclusive close below $13 because it looks like $13 has been an area of support and importance to GDX. So if GDX does break down below $13, you know, we can do similar, how do you call it, measured move and see how far downside of a target we can expect. And once again, I'm going to do a conservative estimate here. So this looks about, what is it, 16%, another $2.60 or so. So looks like we're going to potentially get, if we break down below $13, we could potentially get as low as 10.20 or so. Of course, if you do more aggressive estimate, you can estimate from here, and that's around 21% or $3.70. So that could potentially put us below $10 for GDX. When is it going to happen? I honestly don't know, and it actually makes not that much difference unless you, of course, you're playing options, and I don't normally do that. Anyways, we have uh, market breadth data for GDX. So this is GDX market breadth data is confirming bearish posture. We had new lows and advanced decline lines. On balance volume is pushing lower. We have quite a bit of room to fall. I still think so. Because look at this bullish percent index here in when was this? July, I believe, right? In July, it bottomed out at 0, and at this point, I thought that this is a sort of selling climax, and actually, and it was this huge gap down, and I thought this was a selling climax. Indeed, we bottomed out around $13. Now, we're still, as far as bullish percent index, we're still at 27%, so we still have room to fall for GDX. Let's see. Okay, so next, I just want to briefly look at copper. So let me look at copper next. Okay, so this is a daily price of copper, spot price. Now, again, I don't normally trade copper. Some people do, but this actually quite similar to gold as well. This is a bearish security. You can see the prices are clearly moving downwards. And here we had what looked like kind of like a cup and handle maybe, or inverse double top maybe, or something like this of intermediate nature. And then we had a support break here just in mid-November. And if you just do a measure, how high this pattern is here, this is a 9.5%. And then after a support break here, we had a 9.5% move, and it kind of moved down here, and then we had some sort of a meaningful bounce. Of course, it got sold immediately, but the fact of the matter is this 9.5% was duplicated on the downside before any kind of meaningful bounce even was contemplated. So once again, similar picture to gold is that if I'm correct, and indeed we just had a support break in gold, we could see this similar pattern duplicated on the downside, just like I pointed out a minute ago. You can see the on-balance volume for copper is also breaking down, and it's confirming this move lower. All right, next let's look at oil, West Texas Intermediate Light Crude. This is a spot daily price. Again, a bearish security. You can see the green line is above the red line, which is a 50-day below the 200-day. We had a multi-year low here in August, and then we rebounded. Now, many commentators noticed that this was like a bull flag, possibly. We had three white soldiers here, three candlesticks, and then we had a bullish. Well, it looks like a bullish consolidation, but then we had an attempt at a breakout, a clear rejection. It was kind of like a shooting star rejection here, continued by further selling, more rebound, and then, by the way, here I notified my subscribers of a selling opportunity, and actually we took it. A breakdown here below this level, below this 43.21 support level, is important, and then a continuation lower. Now we have been kind of like rebounding, I guess, to this broken support level with a rising wedge pattern, and I think again the price was rejected here at just at the broken support with this long selling tail. And then on Friday there were quite a bit of selling. Price lost 3.3%. So it looks like the sellers stepped in again. And well, I mean, this bearish wedge has not been resolved to the upside to the downside yet. And this is a bearish wedge because we had a significant move down first, followed by a corrective move, and then if we break the support, or rather break this bear wedge, we could easily see more selling pressure. So for now, we could actually break this bear wedge and continue down to multi-year lows and retest this multi-year lows. If we don't hold this support here, again we could see kind of like this whole thing duplicated on the downside. So let me just do a quick measured move again, and I don't know, let's be conservative again. Let's like look from here maybe. So if this is about 13%, if we break down from here, those $30, it'll 30, so it'll put us down, let me see, around $5 more, so about $32 or so. But if we're more aggressive, we could measure it from here, and if it's about $12 down, so yeah, we could see oil below $30 sometime in the future. It's entirely possible. All right, and briefly let's look at natural gas. So very bearish, very strongly bearish security. Looks like we have not had a close above this 50-day moving average, the red line, since August. So the past, 1, 2, 3, 4 months almost, we had very little buying pressure. Now I thought here we had look like a hammer candlestick after we hit the multi-year lows actually intraday, and then a rebound. Now I was kind of surprised that the sellers came in here even before we reached the 50-day moving average. I was thinking we're gonna get somewhere to maybe $2.50, maybe 2.55. Excuse me, but it actually never happened, and then the sellers stepped right in and pushed the prices lower again. Now, looks like we closed at $2.23 on Friday, and that's a multi-year low, multi-year closing low here. Uh, I mean, where is this gonna go? I was hoping for a rebound so I can go short again, but that clearly didn't happen, and we may just continue lower until some sort of a intermediate bottom is reached. Again, we can do a measured move real quick. If this is kind of like we can measure this height of this pattern. Again, I'll be very conservative, maybe from here to a breakdown. So this could be another 6% down. So this could put gas to around $2 or so. And if you're more aggressive, this could be even even lower than $2. All right. Let me briefly show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have trade alert services that are live right now, so please sign up for them. It's only $20 per month or so. I think it's well worth the price, and you get very timely notifications by email or by text of the various opportunities to go long or go short in stocks, commodities, bonds, etc. Sign up for our mailing list also for specials on the service and for all kinds of good information. If you go to public charts and social page, uh, you can find a link there where I post most of the charts that are mentioned in this video. If you have Twitter, Facebook, YouTube, or StockTwits accounts, follow us there as well. That's it for this week's recap. Thanks for watching and have another great trading week. Bye bye.